I need to tell you about something that didn't happen yesterday afternoon. And in certain markets, what doesn't happen tells you more than what does. At 14:37 London time, a buyer submitted a bid for physical metal delivery out of a London dark pool facility. The bid was $200 over the prevailing screen price. Not $2, not $20, $200. The bid was refused, not countered, not negotiated. The metal exists on paper. It exists in inventory reports. It exists in forward curves and settlement statements. But when someone showed up with full payment, full documentation, and a premium that would make most traders salivate, the answer was no. I'm going to walk you through what I observed in the 12 hours that followed, because this is not about one transaction. This is about what happens when the assumption underlying an entire market begins to separate from the mechanism that market was built to perform. I monitor several communication channels used by physical commodity brokers and logistics coordinators in London. These are not public exchanges. These are private groups where people who move actual tonnage talk to each other about availability, transport windows, and counterparty reliability. Yesterday, starting around 15 West GMT, those channels went quiet. Not slow, quiet. The kind of quiet that comes when people are either waiting for instruction or choosing not to commit anything to a record. I made 4 calls. 2 went to voicemail. 1 was answered, but the conversation was redirected within 30 seconds to a compliance officer who told me there were no comments on current market conditions. The 4th call connected, but the person on the other end said they had been told not to discuss specific transactions and that all inquiries should go through official request channels that normally take 72 hours to process. That's not normal. In physical markets, speed is everything. When someone puts a 72-hour buffer between a question and an answer, it's because they're buying time to decide what the answer should be. Let me explain why this specific transaction matters and why London matters. The London Metal Exchange and its associated storage and settlement infrastructure are not just a regional market. They are a global reference point. When a price is struck in London, that price ripples out to supply contracts in 16 countries. When metal is certified and stored in an LME-approved warehouse, that metal becomes fungible collateral. It backs loans. It underwrites performance bonds. It gives confidence to procurement managers in Munich and Jakarta that if their primary supplier fails, there is a fallback. London is not the largest market by volume, but it is the deepest market by trust. It is where paper and physical are supposed to reconcile. When that reconciliation stops happening, you don't get an announcement. You get refusals. You get delays. You get people referring inquiries to legal departments. What I saw yesterday does not look like panic. Panic is visible. Panic is volatile. Panic shows up in 3 standard deviation price swings and margin calls and forced liquidations. What I saw looks like containment. It looks like someone, or several someones, decided that certain movements should not occur, and that decision was communicated vertically through institutions that depend on access, not autonomy. This is not a conspiracy theory. This is a description of how concentrated markets behave under stress. If 5 entities control 70% of available inventory, and those 5 entities receive guidance, formal or informal, that stability is the priority, then stability is what the screen will show. The screen will show orderly 2-sided markets. It will show tight bid-ask spreads. It will show business as usual. What it will not show is that a $200 premium was rejected, because that transaction never made it to the tape. Here's what you need to understand about the difference between paper and physical. A futures contract is a promise, an option is a probability, an ETF is a claim on a claim. These instruments are essential. They allow price discovery. They allow hedging. They allow leverage. But they are not the thing itself. When you hold a contract, you hold a right. When you hold physical metal in allocated storage with clear title, you hold the metal. The distance between those 2 positions is normally invisible. It's a friction cost. It's a transport fee. It's a timing mismatch. But when that distance expands suddenly, when a right cannot be converted into possession even at a significant premium, that distance becomes a fault line. I received a message late last night from someone who works in procurement for an industrial manufacturer in Central Europe. I'm not going to name the sector, but this is a company that uses this particular metal in a production process that runs continuously. They cannot stop the line without incurring penalties that run into 7 figures per day. Their normal supplier notified them last week that the next scheduled delivery would be delayed by 6 weeks. 6 weeks. They were told it was a logistics issue. They were offered a partial delivery at a 20% premium with no guarantee on timing for the remainder. This company then tried to source supply through 3 separate brokers. 2 of them said they could not fulfill the order at any price. The 3rd quoted a price that was effectively confiscatory and required prepayment in full with no recourse if delivery failed. This is not a company that lacks capital. This is not a speculative buyer. This is a manufacturer with long-term contracts and audited financials and relationships that go back decades. And they cannot access physical metal at a price that makes economic sense even though the screen price suggests abundant liquidity. That is the gap I'm describing. That is the separation. Now let me bring in the second layer, because this is not just about London, and it is not just about storage. There is a refining bottleneck that has been building for 8 months. 2 major refineries in different jurisdictions have reduced output, citing regulatory compliance and equipment maintenance. One of those refineries has a 4-month backlog. The other is running at 60% capacity with no public timeline for returning to full operations. Refining capacity is not something you can replace quickly. It takes years to permit and build. It takes months to restart if you shut down. When refining slows, the gap between mined material and usable material widens. You can have ore, you can have concentrate, but if you can't refine it into deliverable form, you don't have supply. On top of that, these are not isolated disruptions. These are compounding failures in a system that was optimized for efficiency, not resilience. Efficiency means minimizing inventory. It means just-in-time delivery. It means leveraging every dollar of capital. Resilience means buffer stock. It means redundancy. It means paying for capacity you might not use. For 30 years, the market chose efficiency. And now, when one link weakens, there's no slack in the system to absorb it. So what happens next? Here's what I expect to see, and here's what I expect you'll be told. The official narrative will focus on temporary tightness. It will cite holiday schedules, weather delays, or administrative processing times. It will suggest that concerns are overblown and that markets remain orderly. You will see screen prices that do not reflect the premiums being demanded in private negotiations. You will see inventory reports that do not distinguish between metal that is available and metal that is encumbered by prior claims or legal holds. You will see liquidity statistics that count contracts, not deliveries. This is not dishonesty. This is how concentrated systems manage perception during stress. If you are a central bank, a regulator, or a major institution with systemic importance, your priority is to prevent a loss of confidence that could trigger a broader unwind. You do that by controlling the narrative. You do that by ensuring that price signals remain within expected ranges. You do that by quietly managing who gets access and who does not, without making that management visible. The danger is not that this strategy fails loudly. The danger is that it succeeds quietly, and that the market continues to function on paper while the real economy starves for supply. Because the real economy doesn't care about the chart. It cares about whether the metal shows up at the loading dock. It cares about whether the production line keeps running. It cares about whether contracts can be honored without force majeure clauses. Let me ask you 2 questions. First, if you own shares in a commodity fund or an ETF that tracks physical metal, do you know where that metal is stored, who has legal title, and whether it can be withdrawn on demand? Most people assume the answer is yes. I would suggest you verify that assumption. Second, if a market can refuse a $200 premium bid without explanation, what does that tell you about the difference between the price you see and the price you would pay if you actually needed delivery? I'm not telling you what to think. I'm telling you what I observed. I'm telling you that silence in a market that is normally noisy is a signal. I'm telling you that refusals in a market that is normally accommodating are a signal. And I'm telling you that the gap between screen price and physical premium is not a curiosity. It's a measurement of stress. The most dangerous phase in any market dislocation is not the collapse. It's the period right before the collapse, when the system is under strain, but the strain is not yet visible to the majority of participants. That's when decisions get made. That's when access gets prioritized. That's when the people who understand the difference between a claim and possession start moving. By the time the headline breaks, the repositioning is already done. I don't know if this specific situation escalates. I don't know if it resolves quietly. What I know is that a $200 premium bid was refused, and that refusal was not an isolated event. It was part of a pattern. And patterns like this don't usually reverse on their own. They either break into the open, or they get papered over until the next stress point. I'll continue monitoring this. If there are developments, I'll brief them here. If you found this useful, subscribe for the next update. And if you have direct experience in physical commodity markets or logistics, I'd be interested in your perspective in the comments. Not speculation, observation. What you've seen, what you've been told, what's changed. That's the briefing. Stay calibrated.